What if I told you that investing $10,000 in the right high dividend ETF could have made you $5,761 more than choosing the wrong one in less than 2 years? I'm not talking about some risky penny stock or cryptocurrency gamble. I'm talking about 3 of the most popular dividend ETFs that every income investor is talking about right now. Here's the brutal truth that nobody wants to admit. While you've been settling for those pathetic 2 to 3% dividend yields from traditional blue-chip stocks, inflation has been silently destroying your purchasing power. Your grocery bill has gone up, your rent has increased, but your dividend income? It's barely moving. You're essentially getting poorer every single month while thinking you're playing it safe. But what if there was a better way? What if you could potentially earn double-digit yields while still getting exposure to the world's most successful technology companies? Today, we're putting 3 heavyweight ETFs in the ultimate showdown. We have QQQI, the yield monster promising nearly 14% annual dividends. There's JEPQ, the established champion with $23 billion in assets under management. And we have GPIQ, the young dark horse that's been quietly crushing the competition. By the end of this video, you'll know exactly which one of these ETF deserves your hard-earned money, and more importantly, which ones you should avoid at all costs. Because here's what Wall Street doesn't want you to know. Not all high-dividend ETFs are created equal, and choosing the wrong one could cost you thousands of dollars over the long term. Before we dive into the shocking performance numbers that will probably change how you think about dividend investing forever, let me introduce you to our 3 contenders. Think of this as the tale of 3 very different fighters, each with their own strategy, strengths, and potentially fatal weaknesses. First up, we have GPQ, the JP Morgan Nasdaq Equity Premium Income ETF. This is the established heavyweight champion with an impressive $23.4 billion in assets under management. GPQ has been around since May 2022, making it the veteran of this group. It promises an 11.13% dividend yield and uses what they call equity-linked notes, or ELNs, to generate income. Think of GPQ as the conservative boxer who plays it safe, relies on structured strategies, and has built a massive following. But here's the question: is this veteran champion getting a little too comfortable, a little too slow? Next, we have QQQI, the NEOS Nasdaq 100 High Income ETF, and this one is the absolute yield monster. With a staggering 13.90% dividend yield, QQQI promises the highest income of our 3 contenders. Launched in January 2024, this newcomer has already accumulated $4.29 billion in assets. QQQI uses a selective covered call strategy combined with call spreads. And here's where it gets interesting. They reinvest option premiums into out-of-the-money contracts. This is like the aggressive fighter who throws knockout punches and isn't afraid to take risks for potentially massive rewards. Finally, we have GPIQ, the Goldman Sachs Nasdaq 100 Premium Income ETF. This is our dark horse, launched in October 2023 with $1.44 billion in assets. GPIQ offers a 9.91% dividend yield, which might seem low compared to QQQI, but don't let that fool you. This fund uses what they call a dynamic covered call strategy, selling call options on only 25 to 75% of their holdings rather than the entire portfolio. Think of GPIQ as the agile fighter who adapts mid-fight, changing strategy based on market conditions. Now here comes the part that's going to blow your mind and probably challenge everything you think you know about dividend investing. While most investors were chasing the highest yield numbers, completely mesmerized by QQQI's nearly 14% promise, something incredible was happening behind the scenes in 2025. GPIQ, the fund with the lowest dividend yield of the 3, quietly delivered the best total returns. Let me repeat that because it's crucial. The fund promising the smallest dividend actually made investors the most money. GPIQ posted 10.85% year-to-date returns, while QQQI came in at 10.8%. But here's the real shocker. GPQ, the massive veteran champion with over $20 billion in assets, delivered a pathetic 5.69% return. That's less than half of what the other 2 achieved. But wait, it gets even more dramatic when we look at the real money impact. If you had invested $10,000 in each of these funds since their inception, here's what your investment would be worth today. GPIQ would have turned your $10,000 into $15,761. JEPQ would be worth $14,991. And QQQI, despite its monster yield, would only be worth $12,020. Think about that for a moment. The fund with the lowest dividend yield made you over $3,000 more than the one with the highest yield. This is the perfect example of why chasing yield can be one of the most expensive mistakes you can make as an investor. Sometimes the tortoise doesn't win the race, and sometimes the flashiest promise isn't the most profitable one. So what's really going on here? Why is GPIQ crushing the competition, while JEPQ, despite its massive size and experience, is falling behind? The answer lies in their strategies, and understanding these differences could save you thousands of dollars. GPIQ's secret sauce is what they call a dynamic covered call strategy. Instead of selling call options on their entire portfolio, like most covered call ETFs do, they only cover 25 to 75% of their holdings. This is like being a smart poker player who knows when to hold and when to fold. When the market is rallying hard, GPIQ can capture more upside because they're not completely capped by call options. When volatility spikes, they can generate more premium income by increasing their covered call percentage. It's flexible, it's adaptive, and as we can see from the results, it's incredibly effective. QQQI takes a different approach with their selective covered call strategy combined with call spreads. They don't just write calls on their entire NASDAQ 100 exposure. Instead, they reinvest those option premiums into out-of-the-money contracts. This is like being a calculated risk taker who hedges their bets. The strategy allows them to capture more upside than traditional covered call approaches while still generating that massive 13.9% yield. Plus, and this is huge, QQQI benefits from special tax treatment that we'll discuss in a moment. JEPQ, on the other hand, uses equity-linked notes instead of direct options trading. Think of this as the old-school approach. ELNs provide principal protection, which sounds great in theory, but they lack the agility and adaptability that markets demand. In rapidly changing conditions, especially during the strong tech rally we've seen in 2025, this structured approach has proven to be a significant disadvantage. GPQ is like the heavyweight boxer who relies on the same combinations he learned 20 years ago, while his opponents are using modern training techniques. But here's where things get really interesting, and this is the hidden killer that most investors completely ignore: fees. GPIQ charges just 29 basis points, or 0.29% annually. GPQ sits in the middle at 35 basis points, but QQQI, despite all its yield promises, charges a whopping 68 basis points. That 39 basis point difference between GPIQ and QQQI might not sound like much, but over 20 years on a $100,000 investment, that difference could cost you over $8,000 in fees alone. Now we need to talk about the elephant in the room that most financial advisors either don't understand or conveniently forget to mention: taxes. This is where the story gets even more interesting and where JEPQ's problems become crystal clear. Both QQQI and GPIQ benefit from something called Section 1256 tax treatment. What this means is that their option income is taxed as 60% long-term capital gains and 40% short-term capital gains. For high-income investors, this can be the difference between keeping 60% of your dividends versus 80%. That's a massive advantage that compounds over time. GPQ, however, because of those equity-linked notes we talked about, has all of its distributions taxed as ordinary income. For someone in the highest tax bracket, this means giving up potentially 20% more of their dividend income to Uncle Sam every single year. Over a decade, this tax inefficiency alone could cost you tens of thousands of dollars, especially on larger positions. But QQQI has an additional secret weapon that makes it even more tax efficient: return of capital distributions. A significant portion of QQQI's distributions are classified as return of capital, which means you don't pay taxes on them immediately. Instead, they reduce your cost basis, and you only pay taxes when you sell the fund or when your cost basis reaches zero. It's like getting an interest-free loan from the IRS, allowing your money to compound without the drag of annual taxes. However, and this is crucial, return of capital distributions can be a double-edged sword. They can indicate that the fund is paying out more than it's actually earning, which raises questions about the sustainability of that monster 13.9% yield. This brings us to perhaps the most important question of all: which of these dividend payments will actually be there in 5 years? Because here's what the marketing brochures don't tell you. High yields can disappear overnight if they're not backed by sustainable income sources. GPIQ appears to have the most sustainable distribution model. Their dynamic strategy generates income from multiple sources: option premiums when they sell calls, dividend income from their underlying holdings, and potential capital appreciation when they reduce their covered call percentage during market rallies. This diversified approach to income generation provides multiple layers of protection for their distribution. QQQI's sustainability is more questionable. While their selective option strategy is sophisticated, the heavy reliance on return of capital distributions is a yellow flag. When a fund consistently pays out more than it earns through dividends and realized gains, it's essentially returning your own money to you while calling it income. This can work in the short term, especially during bull markets, but it's not sustainable forever. GPQ's structured approach, while conservative, has proven to be too inflexible in changing market conditions. The fund's underperformance in 2025 suggests that their ELN strategy may not be generating enough income to support their 11.13% distribution without eating into capital. Their recent monthly distribution of $0.44377 per share in August shows consistency, but the total return performance raises questions about long-term sustainability. After analyzing the performance, costs, tax efficiency, and sustainability, here's my ranking for different types of investors, and I want you to really think about which category you fall into, because this decision could impact your financial future for decades. If you're an income maximizer who absolutely needs the highest possible yield, and you're willing to accept higher fees and potential sustainability risks, QQQI might be your choice. That 13.9% yield is undeniably attractive, and the tax benefits through Section 1256 treatment and return of capital distributions can be powerful tools. However, you need to watch those 68 basis points in fees and monitor the sustainability of those distributions carefully. For tax-sensitive investors, especially those in higher tax brackets, both GPIQ and QQQI offer significant advantages over JEPQ. The Section 1256 tax treatment alone could save you thousands of dollars annually compared to JEPQ's ordinary income taxation. If you're in this category, JEPQ should probably be off your list entirely. For investors seeking the best total return potential while still generating substantial income, GPIQ is the clear winner. The combination of superior performance, lowest fees, excellent tax treatment, and what appears to be the most sustainable distribution strategy creates a compelling value proposition. This is why GPIQ has seen explosive growth, crossing the $1 billion asset milestone and attracting substantial institutional interest. Conservative income investors who prioritize principal protection might still consider JEPQ, but honestly, if you're that conservative, you probably shouldn't be in covered call ETFs at all. You'd be better served with high-grade corporate bonds or treasury securities. Here's my final ranking. GPIQ takes first place as the complete package, offering the best balance of performance, cost efficiency, tax treatment, and sustainability. QQQI comes in second as the yield king, but with important caveats about fees and distribution sustainability. GPQ, despite its size and market presence, ranks third due to underperformance, tax inefficiency, and lack of strategic flexibility. Before you rush to your brokerage account and invest a single dollar, I need you to understand something critical. These are not risk-free investments. Covered call ETFs can and do lose money. Those high yields can disappear overnight if market conditions change or if the fund's strategies stop working. The covered call strategy inherently caps your upside potential in exchange for income, which means you'll miss out on some gains during strong bull markets. Never, and I repeat never, invest more than 10 to 20% of your total portfolio in covered call ETFs. These should be considered satellite holdings, not core positions. The income is attractive, but the complexity and risks require careful position sizing. Here are your action steps if you're considering any of these funds. First, honestly assess your tax situation. If you're in a high tax bracket and investing in a taxable account, the tax differences between these funds become massive. Second, decide whether you want maximum income or best total return, because those are two different objectives that require different fund choices. Third, consider your risk tolerance carefully. Higher yields almost always come with higher risks. Fourth, if you do decide to invest, start small and dollar-cost average your way in. Don't put a lump sum into any of these funds without testing the waters first. I want to know which ETF matches your investment goals. Are you willing to accept lower yields for better total returns, or are you purely focused on maximizing income? Let me know in the comments below because your feedback helps me create better content for future videos. If this deep dive analysis was helpful, make sure to like and subscribe and hit that notification bell. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.